Markets are at all-time highs. Q2 earnings season is wrapping up, and we have the Fed meeting at Jackson Hole this week. With an exciting week taking place, are markets going to continue their upward momentum, or are they ready to crash? Tune in to find out.
Hi, welcome to T-Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
And like Dustin, how he mentioned in the opening to this video, we're going to be talking about market all-time highs. What does that mean for you? And essentially, should you be investing or having your money invested when it's at the all-time highs?
Yeah, I think that's a good conversation to have, Jay, because I know, like yourself, when markets are at all-time highs, I get lots of questions from clients, whether it be who are already in the market or people with new money. Should they be putting money into the markets when we're at an all-time high? And psychologically, you see markets at all-time highs and you kind of think, oh, well, what goes up must come down kind of mentality. And so it can be very nerve-wracking to put new money to work or be investing at all-time highs. But with that being said, we have a lot of interesting data to look at that actually says investing at all-time highs may not be the worst thing. You actually get relatively good returns when you are investing at all-time highs, and they're actually not that uncommon as you might think.
Yeah, and the alternative to not putting all of your money in at once would be what's called dollar cost averaging, where you would take maybe 5 or 10% and slowly drip it into a portfolio throughout the course of either a year or 12 months, whatever the case is. And a lot of clients I talk to, especially that have just free cash sitting around and they want to invest it, they always tend to want to go to that approach just because, like you had said, Dustin, they are worried about putting it all in, especially when the market's high, and having it drop all of a sudden. And
yeah.
This is money that's just been cash. It hasn't lost anything or made anything. And to them, if it drops down 1% from where we started, then it's kind of like the end of the world type thinking. Like, oh, I'm losing all my money. All the market does is go down. Why do we do that? And that's why we usually find clients are more comfortable with wanting to dollar cost average.
A lot of times when markets are at high, I would say from a psychological standpoint, they are more comfortable dollar cost averaging, but the data actually shows you're better off lump summing it. It ultimately over a long time period, I don't know that it's going to have as much of an impact, but I think just from a pure psychological standpoint, it does have some impact. And I'm going to share my screen here. So let's take a step back. Here's a really great article from Ben Carlson. He's a CFA with Ritholtz Wealth Management. He wrote an article back on July 4th of this year, investing a lump sum at all-time highs. He has a really interesting blog. You can go and check it out, A Wealth of Common Sense. But a couple of points that he makes, I thought this one was pretty interesting. Number of new all-time highs in the S&P for each year, and this goes back to 1990. The average number of all-time highs in any one year is 20. But as he points out, they tend to cluster around different time periods. This is kind of an interesting, I guess, selection of years because, of course, you have the 90s, which had a lot of IPOs, a lot of technology companies did extremely well, and you had the dot-com, bubble. And you can see here, we didn't really, I won't even count 2007. I mean, there was 9 new all-time highs, but we had all these all-time highs, and then we had a decade really of no all-time highs until we got out of the financial crisis. And then 2013 started, and we had, you can see a lot of new all-time highs in these years. And 2025, this is going to be a little behind because we don't have up to date. We're filming this middle of August, but there was 6 as of his writing here. So I think that's going to be a little bit more. But again, the average is 20, so it's not uncommon to have all-time highs in any one year, and sometimes they're going to be clustered around different time periods. But just because we're at an all-time high, I don't think that means necessarily that it's bad news and you shouldn't invest. But he has another great chart here that all-time highs are very common. This is a chart that goes back to 1950. The blue line is the S&P 500 price. The gray are all-time highs. I mean, the gray dots almost take up all of the chart here.
Yeah, it's very interesting.
Yeah. So I would say too, one thing to remember is like all-time highs means that there's a lot of momentum in the market. Those things tend to be good indicators that all-time highs, kind of breed all-time highs. And of course, that does come to a head at some point here, as you can see these different time periods. But there's a lot of clustering of these all-time highs, one right after another, because you get these all-time highs. There's obviously a lot of reasons for that, which we'll get into for current reasons, and that just kind of keeps driving the market higher and higher and higher. And it doesn't let people in almost, because you do have the people who say, oh, well, I'm going to wait for the market to decline 20%, or, oh, it went up so high, it's got to crash, or whatever. Sometimes those people kind of get left on the sidelines, always watching these new highs come. And, sometimes they don't get their opportunity for quite a while.
It's kind of like that mentality that, like the saver mentality, or trying to find a good deal, in a sense. And yeah, like, okay, that might happen, but chances are it might not, and you're missing out on even more potential growth.
So two, they talk about the returns in the S&P 500 as whether you were to put the money in, and what those returns, when it's at an all-time high, and what those returns are 1, 3, and 5 years later. So I think the interesting thing is it looks like 1, 3, and 5 year later, this goes back to 1950. If you were to lump sum invest in these time periods, forward return, they're all higher. If you were to invest on an all-time high day, as opposed to investing on any other day, it looks like. So again, marginally higher. Some of these over, a 5-year period, let's call it almost 2% higher rate of return. I think that's pretty interesting, because I think a lot of people would say, oh, well, if I'm investing at an all-time high, there's a crash right around the corner or what have you, but the data doesn't support that. So maybe let's transition, Jay. We're in, I'll just say, an environment of all-time highs, right? And a lot of people that I talk to, want to know, well, why is the market making all-time highs? They have all these reasons as to why it shouldn't be at all-time high. And I'll say a lot of it, there's a lot of political undertones to those conversations typically. A lot of negative things that we can always pick out. There's always negative things going on. But what I go back to is some fundamental type of reason as to why markets are where they are. And of course, we're in 2025. We've had April of this year where the market took a huge decline, overreacted, I think we can say now, as to what the impact of tariffs were going to be. And now we're back to business. We're back to some of these all-time highs. And I think there's plenty of reasons for that. So we're going to jump over to a little bit of an older article. This is from JP Morgan. This was published 11/20/2024. But the main point that I wanted to get across is really what they classify, or what the reasonings why markets are at all-time highs. Because back in 2024 of last year of November, markets were all-time highs. And JP Morgan points out that profits drive equity returns. And I think that's really important to remember, because ultimately when we're investing in the S&P 500 or whatever index or whatever individual stock, a lot of it long term comes down to, okay, what profits are these companies getting on a long term basis? Are they improving their business? Are they running more efficiently? Are they having organic growth? There's a lot of things behind it, but profits are driving equity returns. And if we believe that to be the case, we can jump to something that is up to date. This is an analysis done by Wisdom Tree and Matt Wagner over there at Wisdom Tree. And this was posted, it looks like maybe updated today. But ultimately, this looks at Q2 earnings of the S&P 500. So we're almost towards the end of earnings season. 83% of the S&P 500s have reported as of this writing of Q2 earnings. And here's what I wanted to point out. If you wanted to look at why markets are at all-time highs, don't even count the fact that there's a lot of money on the sidelines, that interest rates have been kind of dwindling down. They're expected to come down further. Money market funds are not looking as attractive going forward. There's been a lot of negative sentiment as to the outlook for stocks, and I think that's continued as the markets continue to kind of charge higher. It's dragged people in reluctantly, over and over. But ultimately, earnings have come in very, very good, and in fact, they're up 11% year over year. So I think that is telling the story at a very fundamental basis as to why markets are at all-time highs. And what does that mean going forward? We can debate that a little bit too, but I think that overall is a good sign that earnings are up. They're up double digits. It's the third straight quarter of double-digit earnings growth. Here's kind of the breakdown. Obviously, energy with the worst earnings, negative 19. And we have consumer services up here, up 44%, which is huge. But I think that is really at a fundamental level what is driving equity returns.
Yeah, and then if you go to that next chart, just swiping over to the right.
Oh yeah.
The majority of the different sectors are above the higher than normal rate.
Right. No, it's always good.
With only two being like we saw earlier, only two being in the either in line or actually one's just below. And that's right. Just materials.
It says here, earning beats are strong. 78% of companies beat estimates.
Yeah.
Well above the 10-year median of 71%. So I think that's a really good sign. And as we kind of look forward, okay, that doesn't mean that I believe it's just, straight up and to the right from here, right? I mean, I think at this point, especially if you look at the April lows, a healthy pullback would be completely normal and welcomed, I think, in the market. And what does a healthy pullback look like? Okay, 5-7% type of just pullback in the market that kind of resets the deck. It gets some of that froth out of there. If you can see other parts of the market that are not, mega cap tech related, maybe some value kind of catches up here a little bit. If we can have some of these stocks that are just trading at crazy valuations take a breather, which funny enough, this week we have been seeing, I think that's very healthy, and that allows the bull market to continue. So if you're someone who has fresh money to put to work, don't be afraid just because we're at an all-time high. I would say, of course, consider the data that we just presented, but also if it makes you more comfortable, come up with a schedule. I don't think that that's a wrong answer because psychologically it can help you get invested for the long term. Come up with, whether it be 6, 12 months type of time frame that you just put a little bit in each month, and you can say, okay, if the market goes down, I have more to put in, and I think that helps a lot of times kind of settle the nerves.
Yeah, and I think too, if you're really concerned about that, you could have more of a balanced or 60-40 type portfolio where you don't have 100% stocks or equities. You have a mixture of bonds, maybe a little bit in some cash or cash-like alternatives, and so you can just go all in on that. So you're getting some exposure to the market at 100% in with what percentage you have in equities, but then at least you have bonds and cash to kind of help safeguard you as well.
Right. I think something to remember is when you build a long-term portfolio, a diversified portfolio, you're not going all in on the latest AI stock or
Right. Yeah.
tech stock or what have you. It's okay to have some portions of that, but when you build a total portfolio, you're going to have exposure to a lot of different areas, and I think that ultimately protects you from, those worst case scenarios that you might be concerned about.
Right. Yeah.
All right, Jay. Well, if I think we presented a lot of good cases there for kind of what's going on in the market and why people maybe should consider putting money to work if they haven't, or coming up with some type of schedule and not to fear all-time highs. We hope that you found this video valuable. If you did, please like, subscribe, and we'll look forward to seeing you in the next video.